Taking losses in trading is inevitable, but in this video today, I'm going to share with you how I anticipate for high quality, high probability trade setups. The first thing I usually do is to go from the 12-month time frame because I want to have an overview of the overall market direction, whether the market is bullish or whether the market is bearish. And in this case, if you're looking at the 12-month time frame, you can basically see that already the market structure is bullish, consistently creating higher highs and higher lows. The next thing I do after that is to anticipate for my point of interest, and as you can see in this case, my point of interest is the 12-month inefficiency. After outlining the 12-month inefficiency, I use the Fibonacci to determine where we are in the marketplace. And as you can see, we're currently at discount. Overall, if I remove everything on my chart right now and draw that Fibonacci again, from the overall low to the high, we're currently at a discount zone. And this right here is equilibrium. So what this means is that I'm always going to be a bullish trader on Euro US dollar. I'm only anticipating for price to rally to the upside. Now that being said, the next thing I go to monthly time frame, I outline my recent high, recent low, recent right here. So this right here is my recent high and then my recent low. After that, I use my Fibonacci. You can see the Fibonacci right here. The purple lines is my Fibonacci. On the monthly time frame, I'm using the monthly Fibonacci to basically see where we are within the monthly range. And right now within the monthly range, we're at premium, but don't forget overall from the 12-month range, we're still at discount, which means buying at these levels is still buying euro at a cheap price. Now, this doesn't mean that for traders who want to trade with leverage, it doesn't really mean that they should jump in right now and put stop loss 200 pips, because the institutions, how they trade and how retailers trade are not really the same, in as much as we have all these institutional trading concepts flying around the air, but in real time the institutions don't really trade like the retail traders. The retail traders are looking for trades. They're going to use 10 pip stop loss, 20 pip stop loss. The institutions don't trade with that level of small stop losses. The institutions are looking for potential strong lows like here or here or here. Those are key levels. They will classify as their liquidation zones. But no retail trader is going to put their stop loss here or here or here. If you do the maths, just here alone, from where we are right now to this current price action, that's 458 pips. I don't know any retail trader that is going to use 458 pips as stop loss. So you can see the level of how the institutions and retailers trade are two different things. That being said, what I do now is to annotate my recent high and low, draw my fib from the recent high to recent low to know where the equilibrium is. As you can see, this is the equilibrium. Overall, I'm bullish. We're in a new month. There's a new monthly candle forming right now. Today is the 2nd of September. So what that means is, if we're going to continue higher, I'm going to anticipate for a run on sell stop before a potential continuation to the upside. We go to weekly. Now on the weekly, I'm seeing very significant breaks of structure on the weekly time frame. Right here, we'll have a weekly high, weekly low, break of structure. After this break of structure, this right here is my overall last down close candles. Right here. last down close candles. That is the key level I'll be anticipating for price to come down into. And look, it aligns with discount being below the equilibrium. This is equilibrium right here on the monthly. Look right here, this is equilibrium on the monthly, and below that equilibrium is the last down close candles. I head down to daily, and on the daily time frame, I'm seeing this right here, last down close candles. This right here, price went to the downside, rallied, broke structure, retracement, mitigated this inefficiency, broke structure. You can see that very clearly. So right here, this right here is liquidity, daily liquidity. If we go to 4 hour, you can see this right here. What we have right here is a low resistance liquidity. That's what we have right here, low resistance liquidity. This is the daily liquidity, also aligns with the 4 hour liquidity, and we'll have an inefficiency resting right there as well. So this is the key level I'm watching. I'm watching this very closely. And if we should see for any reason, whether fundamental reason or technical reason, we see the dollar drop off, we see the euro drop off from where we are now, running this sell side liquidity, this would be the perfect area I'll be anticipating for the market to come down into, and then I'll be watching it very closely if the market comes down there. So that is my analysis. If you found it insightful, you know what to do. Follow me for more insights. I'll see you in the next one.